Welcome to the Clear Diagnostics Tax CPA Success Show, where we share updates on current tax law, operational stories from the tax practice of our virtual CFO firm, and anything else tax related that comes from being a leading distributed virtual CFO firm. If you're a CPA in tax practice who wants to learn strategies to minimize taxes for your clients, then this podcast is for you.
Welcome to the Clear Diagnostics podcast. I am Tom Wadelton. I'm one of the virtual CFOs here at Summit CPA Group. I'm joined by Dave Danic, who is our tax director at Summit CPA Group, and then also Randy Crabtree. And Randy works at Tri-Merit Specialty Tax Services. So to our speakers, welcome today.
Hey,
so Dave,
thanks for having us, Tom?
Yeah, what's our big topic that we're talking about today?
Today is the employee retention tax credit, and this has been a very popular credit since the pandemic has started, and it's been a great opportunity for our clients to get some pretty massive tax benefits, and it's one that can be easily confused. So at Summit CPA Group, with our capacity issues, with the growth that we've had, we've decided to bring in specialists such as Randy's firm and other firms to help us navigate this so we can quickly get these credits turned around. So Randy, thanks again for all you do.
Yeah.
It's a great opportunity for our clients. So if you could please introduce yourself really quick, and then let's just jump right into it. Tell us more about what this ERC is.
Tom, Dave, thanks for having me. I really appreciate this. I can talk ERC all day, so you guys will have to cut me off at some point. No, we'll keep it short. Just a little background on me. I am a CPA. I came out of public accounting 15 years ago and started Tri-Merit, the specialty firm. We support CPAs. Typically, our business comes from CPAs. We support CPAs like you guys with bringing them specialty tax areas. Traditionally, we started as an R&D tax credit firm. We now have 6 services, employee retention credit being a very significant one the last year plus now.
Very good. And just a quick story. When I first saw these credits come through, we had a client and we worked through it, and their credit was like $130,000 for not that huge of a company. And I'm like, is this for real? And I'm like, and they were like, is this for real? And it was. So yeah, how's this add up so quick?
It's interesting because it's funny because I mentioned R&D tax credits. That was the same thing we would get 15 years ago. Is this for real? I mean, this can't be true. We're not getting this big a refund. And ERC has been the same way. And so what you just mentioned, $130,000, you could have 5 employees. And if you qualified for the entire period of the credit, that's what the number would be, is $130,000. And it adds up quickly, but not everybody qualifies. So it adds up quickly if you do qualify from a standpoint of 2020 was a nice credit. 21 blows the 2020 credit out of the water, and that's how it can grow so fast. It's a 70% credit of the first $10,000 of wages, eligible wages per employee per quarter. So we get to look at this every quarter in 21, where in 2020 it was a 50% credit of the first $10,000 of eligible wages for the year, and the year was March 13th, or as soon as you qualified until the end of the year. And so, the 21's what really has ramped up the potential dollars there.
So do I get the credit just by nature of having an employee, or there's got to be, what's the rub here? Like, how do I even sign up for this?
It's not everybody qualifies, and I'll say that 100 times today, maybe not 100, because I hear people being promised these credits that don't exist. Now, that being said, there's plenty of taxpayers that qualify for this that have not taken advantage of it yet. And so to take advantage of it, to qualify, to be eligible to receive these refunds, and that's what it is. It's a refund check. To be able to qualify for that, the qualification activities change from 2020 to 2021. There's a safe harbor in each year, and really in each quarter of each year, there's a safe harbor rule that says if I meet this drop in revenue, I automatically qualify. No questions asked. If I meet the drop in revenue. And so for the year for the year 2020, if a company has a 50% drop in revenue in a quarter when I compare that same quarter in 2019, it's a safe harbor. I qualify. Let's start quantifying the credit. In the year 2021, everything got better. We already said 50% went to 70%, went from an annual to a quarterly. Now it's every quarter we get to look at this. So it's 70% of the first $10,000 of wages. I'm sorry, backtrack. Qualification, that's the part where, I can tell you, I can go everywhere on the ERC, and I will, because my mind's 100 miles an hour. To qualify, let's go there first. In the year 21, you only have to show a 20% drop in revenue in any quarter, and again compared to 19. So we're comparing to pre-pandemic years. So that's how you qualify. That's the safe harbor. And if I can go on for a few more minutes, let me tell you the secondary way to qualify, because this is where there's some confusion. Is if I don't meet the safe harbor drop in revenue, I can still qualify if I can show that my business was affected by some government mandate, some government order, some government restrictions put in place due to COVID. It can't just be, it has to be due to COVID. If I can show that there's something in place that has affected my business, either from my ability to conduct my business in general, my ability to have group meetings, my ability to travel, maybe even my ability to get my supplies, supply chain has been affected, which is a tougher one, and we can go into that if you want. But if I can show that my business has been affected by this government mandate, I can qualify for whatever term I'm affected.
Yeah. Can you give an example of that? Is this like the restaurants that say, "Hey, I can only have X amount of people in my dining room at a certain time," or something like that?
Yep, that's the perfect example. Is restaurant business, theater business, bar business, gyms. And what they were under was a mandate that said, one, for a long time across the country, most of the country, you have to close. Nobody can come inside. Okay, a mandate has affected me. Maybe I can do something different, but I am restricted from doing business the way I was doing it before. Restaurants, nobody can come in. You could still do pickup. You could still do delivery. You could still do, drive-throughs. But if nobody can come inside, okay, now my business is affected. Just to put that further, the IRS says you're affected if that indoor dining was more than 10% of your overall 2019 revenue. So we have to show that there's an effect to it. Even then, when a restaurant was, okay, you can open now, but you're restricted to 50% capacity, let's say. Okay, they're still under a mandate. They're still affected. Let's say they can open that back up to 100%, but 6 feet requirement of spacing in between tables. And if that reduces their capacity, they're still under a mandate. So that's an easy one. It gets harder when you're looking at other industries, but that gives you an idea of a mandate that has affected me, and I can quantify that effect because I have no more indoor dining, or indoor dining was restricted.
Sure. That's interesting. To go back to your percentages, like a 20% revenue drop, like in a given quarter, for some companies, like that's a big drop, but it also might just be a timing issue. Like if say, hey, you know what? It just happened to be I had some clients that delayed some billings that got pushed into a further quarter. Does that timing issue still allow me to still claim this credit, like even if it's not related to
Yeah,
COVID?
they specifically say that the drop in revenue, you do not have to prove it's a COVID related or drop. And so, like you said, we've had businesses that I think have been affected still, but it's, they had a great 2019. They had a huge project. And so, or no, they had a great 2019, huge project.
Yeah.
And then in 2020, they just don't have that same projects. that drop in revenue is a safe harbor. They say if you've had this drop in revenue, and it makes it easier for IRS, they don't have to go audit, was this drop related to mandate, but that's why they give you that secondary way to qualify as well. So yeah, no, to answer your question, Dave, yeah, it's the drop in revenue. We do not have a requirement to say we need to equate that to COVID.
That's great.
And then just to complete kind of the basics, Randy, process-wise, lots of the clients are like, okay, so how does this actually work? And my understanding is amended 941 is filed, claiming the credit if it's a past period, and then you're getting the credit back as a check payment from the IRS.
Yep, it is.
That's simply how it's supposed to work.
Yeah, it is. Yeah. And at this point, we are past the qualified period. So everything, if we did something now, is amended. The credit ended for most businesses at the end of the third quarter of 21. Some startup businesses can take the fourth quarter as well. And, I can define what that is at some point if we want. But so right now, yes, we're amending the 941s. We're going back. Send in the 941X. Unfortunately, we're sending in paper files because that's the way the IRS wants it, all going to one location. And unfortunately, it's a very long processing time on the IRS at this point. It's been, we've been probably averaging 9 months for refunds, and we're hearing rumblings that that's even going to get extended longer, potentially as high as 16 months, probably partly because of tax season, I'm assuming.
Yeah, that's good to know for our listeners, I think, is that, it's easy, it's fun for us practitioners to talk about how much you can get back in this tax credit, but there's still that secondary angle of saying getting the actual money is out of our control or out of your practitioner's control or your CPA's control. Right. Really, like, this backup at the IRS is real, and it's pervasive across the IRS on income tax, payroll tax, credits. So it will come. You just have to temper expectations, thinking you're going to be able to go buy your Corvette in 2 weeks after you.
No, that's not the intent of the credit as a Corvette, but
yeah. Okay.
But yes, yeah. I know what you're saying.
But you could get $130,000 and buy a pretty nice Corvette.
5 employees, $130,000 if you qualify the entire period. Right. So yeah, that would be a nice Corvette for sure.
So when you mentioned, Dave, part of the reason we have gone out is because of some of the complicating factors. I wonder, Randy, if you can talk about that, because I think of things like don't overlap with PPP, and there's some family relationship to the business things you have to consider. So in case people are looking saying, this sounds great, sounds like a pretty simple application to put in, I don't think that's been our experience.
No,
what are some of the complicating factors?
Yeah, no, Tom, you're right on. It started with the very first thing we had to analyze was the PPP and the ERC. Originally, when the ERC was defined, if you took a PPP, you could not get the employee retention credit. So that's why that whole interaction was defined early. 9 months after ERC was defined, they changed that rule and allowed you to take the ERC if you qualified, even if you took a PPP. So we've got that interaction. There's some interactions with FFCRA and FMLA and these other coronavirus employment credits if some people have been out sick. There's a work opportunity tax credit interplay with ERC. There is even potentially the idle loans, could play. Now, there's not a big effect, but it's spelled out that, yes, you have to make sure you're not, doing this. There's certain benefits, like the restaurant revitalization grants, that for a certain period of time, you don't have to worry about double dipping. For another period of time, you can't double dip. So there's just that, when can I use dollars for each? When can I have to segregate it? And then there's some really interesting, I'm a tax geek, I guess, but there's some really exciting, interesting stuff that came out recently on the interplay between the R&D tax credit and the employee retention credit. And we always knew there was an interplay there where we had to segregate out of the dollars. IRS just clarified in the instructions for Form 6765, which is the R&D tax credit form, that interplay is handled differently the first 6 months of 21 compared to the second 6 months of 21, which is really confusing. And so, we did a webinar on this recently, but just that interplay makes no sense. It's the way they wrote things, but you have to analyze all these things. So that interplay with other credits and incentives, maybe even some state grants is out there, and you just have to make sure you're not double dipping on those things.
Wow.
Mm-hmm. Okay.
So what I heard there, Tom, is that you probably need people smarter than us
Right.
who can
You
look
are an
at, dive into the details. And it's really, and that's like kind of just been, well, this is, our tax podcast. And that's just like these last 2 years almost have just been change after change. And it's like being a general practitioner is really hard right
Yeah.
now. If you're, and you have to start picking your specialties of what you can do. And like, because you can hear it, we made it sound really easy. Hey, if I have 100,000 of sales in one quarter, and then the next year I have 75,000, I hit my 20%, and like, oh, let's go get it. No, that's like one step. You want to have some extra help to say, are we clearing all these hurdles? I don't know if they're going to audit all these. I was following on Twitter, like people talking about like this. I don't know if they're going to audit them. Maybe they will in 5 years. They only have the IRS has like 3 people working there right now. So like, I don't know if they're going to do it, but
It's
just
You better be able to stand up to it,
it's
though.
not worth the stress level for us and for our clients to not get it right the
No.
first time.
Right.
And just there's a lot more behind in the
And
small
this was an
print.
interesting
So.
thing to follow because it was everybody wanted it immediately, but it was really ever evolving, and still is to some standpoint. And Tom touched on this briefly before when he asked me a question: is if I'm an owner of a business, can I be using the credit? And the answer is yes or no. It
Right.
just depends on your ownership percentage. But then if I have any relatives that work for me, can they be using the credit? And the answer is yes or no, depending on your ownership percentage, or if you are deemed to own the business through some relationship. So yeah, that whole thing is just it was exciting for me following this stuff. I probably educated 30,000 CPAs last year on the employee retention credit, and I was just constantly reading and finding out, and it was exciting. Again, makes me geeky, I guess, but
Yeah.
it was exciting.
So
Yeah.
yeah, so but if you're a CPA listening, I mean, you've got to be checking in with your clients to make sure that they're not missing this opportunity.
Yeah. And I found with my clients, everyone had heard of the PPP loan. I mean, it was front page in newspapers and people you wouldn't expect to. Few people had heard about this, and they were excited and they were skeptical. Dave, to your point with the complications, us going outside, it was very valuable. And I also didn't get any pushback from clients when I said, hey, this isn't our specialty. There's going to be a fee. It's about this much of what you have in the ERC. And what I especially want to avoid is if we try to do it, and let's use the 130,000, if they came back later and said, hey, you were wrong, it was really only 100, I don't want the client a year and a half from now writing a check for $30,000, right? Yes, it was 100, was still worth it, but that's a miserable experience for everyone involved when it's all gone out of their account. And now you're like, oh, sorry, you owe some back because we made a small mistake. I'd rather use an expert to do that.
Yep.
Yeah.
And I'm very fortunate that the last year all I concentrated on was this. I'm also spoiled because I can choose to do that, but that's all I concentrated on. So it was it's definitely an interesting area.
Very good. So we're wrapping up. I don't know how we could talk about ERC all day, but I don't think our listeners want to hear about it. So Randy, like, what are some steps do you think that a CPA should take working with their clients, or if it's a small business owner listening, what do you think their next step should be?
Yep, that's good, because what I've said is that every taxpayer needs to look at this because every situation's unique. Now, not every taxpayer is going to qualify, and you guys know every single taxpayer in the country is being marketed ERC nonstop right now because it is such a valuable asset. But unfortunately, this is my opinion, a lot of companies are being promised credits that don't exist. So analyze everybody, look at it. You as the tax preparer, let's say right now, or you're the taxpayer, you're not going to have all the expertise. So have somebody that you have confidence in, or that your CFO has confidence in, or your CPA has confidence in, to go and do the analysis of this to see if you really qualify. I actually have a letter out that I give to anybody that wants to give it to their clients that says, here's how you qualify. Here's the values. if you want to talk and evaluate yourself personally, here's a phone number to call, and they can reach out to me or anybody in our company or to you guys, and you reach out to us, or the CPAs, they reach out. However, I just think it's important to be, as the advisor, to be the one to bring it to the client, because somebody's going to email the client about it, and let's not take the chance on who that's going to be.
Yeah.
So that would be my first step, and then see if they really do qualify.
That's awesome. Very good. Randy, how do people get in touch with you?
So our company is, as Tom said at the beginning, Trimerit, TRI-MERIT, and then hit a .com after that. That's the website. And on there's a, about us or contact us, or you can find my information. I'm on LinkedIn. I do a lot of webinars, so you'll see that put out there. I get to talk to guys like you a lot, which is fun, and talk about it's an interest. It's an industry I love. In fact, I was on 2 other podcasts this morning. 2 I interviewed other people on, and it's just fun industry to talk about, the tax and accounting end of things. So trimerit.com, probably the best place.
That's what we keep telling ourselves, that it's a fun industry. On February,
I'm glad to have you guys around.
The middle of February.
Yes.
Yeah, that's great.
Well, thank you both. This has really been valuable. I thought I knew a lot about ERC, and I learned quite a few things today, but I think for anyone thinking this might be good for their clients, hopefully this is an educational part, and then they also have expert resources they can reach out when they say, okay, I really want to do this and want to move forward.
Very good. Well, thanks, Tom.
Yeah,
thanks,
thanks
Randy.
for having me.
Enjoy this podcast? Visit our website at summitcpa.net to get more tips and strategies for achieving tax success. We're here to be a resource for you.